Now, generally speaking, back in the old days, to be considered a dividend investor, you likely owned maybe several dividend aristocrats, different single stocks like the ones that we can see right here, lots of blue chip companies that have been paying dividends for several years, maybe even decades, and of course, as a bonus, been raising their dividends over time. Now, this allowed dividend investors to build a portfolio that not only offered consistent cash flow on a quarterly basis, but also have their portfolio grow over time, making their net worth grow with it. Now, along with that, back in the day, dividend investors most of the time bought into dividend growth style ETFs, like one of my favorites, the Schwab US Dividend Equity ETF SCHD, because again, this ETF tracks different single stocks that offer dividends and dividend growth historically. But over the last decade or so, it does feel like times are changing, and with lots of different cover call style ETFs, lots of the ones I actually talk about all the time on this channel and even hold in my personal portfolio, it seems sort of tempting to ditch the single stock dividend aristocrats that might only yield 1, 2, 3% and buy into index-based cover call style ETFs that might offer great total performance, but along with that, massive amounts of cash flow from day one. So in this video specifically, I'm going to share with you guys why I think in particular QQQI and also SPYI, the NEOS ETFs that offer high income potential from day one, around 12 to 14% that is, could be perfect investment vehicles for dividend investors that once again want a positive total return in the long run, but also are seeking a boatload of income from day one. So if you're a dividend investor that's maybe been on the fence with some of these cover call style ETFs, make sure to stick around, drop a like down below, and let's get right into it. My A to Z dividend investing ebook has helped countless dividend investors get started with their journey. And my custom dividend tracker that I'm constantly using here on the channel has also helped so many investors stay on track and allow them to see their dividend income in real time. Well, today I have another treat for you guys. I'm not only going to offer you my A to Z dividend investing ebook and the custom dividend tracker, but also just for a short limited time, I'm going to be adding in my brand new weekly dividend blueprint ebook to show you how you can get started with weekly dividend ETFs and add this into your investing strategy. This offer is not going to last long, so go ahead and click the first link down below in my description, and you're going to get both ebooks and the custom dividend tracker bundle. But like I said, please act fast because this won't be around for long. Now let's get back into the video. Now, before we talk a little bit more about the cover call ETFs and why I think dividend investors should definitely look into those types of investments if they, of course, are looking for growth, total return, and dividends, I want to make it very clear that in my personal portfolio, as a lot of you guys already know, I hold single stocks, names like Realty Income, names like Apple stock, or even names like JP Morgan. But I also, along with that, own tons of different ETFs that offer me exposure to the S&P 500 and the NASDAQ 100, for example, but along with that, in an income format, offers me a boatload of income from day one. And without buying into some of these cover call style ETFs, there's absolutely no way that I'd be able to build out a portfolio that's worth between $1 and $2 million that pays me around $7,800 per month in income, or around $94,000 per year. Now, because of these higher yielding cover call style ETFs, like I stated earlier, there's a lot of income potential from day one. So let's get right into it. Now, why in this video did I want to cover SPYI and QQQI, the NEOS NASDAQ 100 High Income ETF and the NEOS S&P 500 High Income ETF? I wanted to use both of these ETFs as an example that a dividend investor should definitely look into if, of course, their goals are what the typical dividend investor is looking for. Now, I say that because both these ETFs over time, at least based off of their strategy, which we're going to talk about here in a second, have the potential for a lot of income, high income in these examples, but also some growth prospects, and also on top of that, pretty tax-friendly, well-diversified because they track the S&P 500 for this one and the NASDAQ 100 for this one. Now, if you're an investor that does not want to have exposure to the NASDAQ 100 and or the S&P 500, well, then neither one of these ETFs are probably going to be right for you specifically. But for me and like a lot of other investors, we like to have exposure to the S&P and along with it the NASDAQ just because the underlying holdings have grown over time and been very hard to outperform. Now, that being said, there's lots of other covered call style ETFs out there that don't necessarily track the NASDAQ 100 and or the S&P 500, and there really is a product out there for every single investor these days. I always say that in my videos. So again, if you don't necessarily want exposure to the S&P and the NASDAQ, well then maybe these aren't right for you, but for the rest of the viewers that are interested in that, then listen on. So both these ETFs are basically the same, more or less. I'm sure you guys maybe have even heard about them, but let me dig into why these ETFs could be perfect for, like I said, a typical dividend investor that wants what a dividend investor wants. It says right here in the strategy, and remember these strategies are going to be identical. The only difference is one of them tracks the S&P and one of them tracks the NASDAQ. But it says targeted benefit strategies. It says the fund seeks to distribute high monthly income generated from investing in the constituents of the S&P 500 index and implementing a data-driven call option strategy. Number two, it says actively managed by NEOS. The fund seeks to take advantage of tax loss harvesting opportunities, in addition to utilizing SPX index options classified as Section 1256 contracts, which are subject to lower 60/40 tax rates. Now, lastly, it says the fund utilizes a call option strategy that may include both selling and purchasing SPX index options, which may provide opportunity for upside capture in rising equity markets. Now, the investment objective, this is very important. Like I said, most dividend investors, can't speak for everyone, but most dividend investors want their portfolio to grow over time. They want a nice positive total return, and a lot of dividend investors want a ton of income. So the investment objective says seeks high monthly income in a tax efficient manner. Again, basically what every single dividend investor out there wants, especially paid out on a monthly basis, is extra helpful for those investors like myself looking to use their dividends, distributions to pay for things like bills. But then lastly, it says with the potential for upside appreciation in rising markets. So not only are you getting the potential for income, which again is around 12% for SPYI or around 14% because the NASDAQ 100 is a little bit more volatile for QQQI. But along with it, you're getting some potential for upside, which I'm going to share with you guys how that's actually performed so far historically, and all along while being pretty tax efficient. Now again, I love to add little snippets like this in my videos just to make everything very clear. There really is a cover call style ETF out there for almost everything that every single person wants. Now, what I mean by that is that there's going to be some ETFs out there that might not offer as much as far as the distribution rate goes, and or vice versa as far as growth, but both these NEOS ETFs sort of offer the best of both worlds as far as high income potential, a little bit of growth or appreciation, and tax efficiency all along while. Now, to be fair, a lot of dividend investors are concerned when it comes to these cover call style ETFs as far as price return goes or NAV decay. And again, some of the cover call ETFs out there do experience massive NAV decay. And again, things like NAV decay or overall total performance is going to depend on how the underlying, in this case, the S&P 500 and the NASDAQ 100, are going to trade over time. So also very important to note that if the NASDAQ 100 starts to tank and drops off a cliff, goes really deep into the red, names like the NEOS NASDAQ 100 High Income ETF is not going to be spared. If the underlying market goes down, this ETF could also go down with it. And I think that's something that a lot of newer investors don't really understand. They always say, well, this ETF might yield 12% or 4%, but what happens in a bear market? What happens to the price of it then? And I always simply say, yes, it can also drop. But at least historically so far, SPYI, because of the underlying mechanics, is up around 8% as far as price return goes, and QQQI is up around 8% also on the max time frame. Now again, in a bear market or if we see some massive volatility, the distributions can of course change, and also the price performance can of course change. But at least so far, since inception, the numbers are the numbers. And if we were to stack up QQQI next to SPYI next to the SPY, remember the SPY is very hard to outperform. If anything even comes close to the SPY, as a dividend investor, I'm pretty excited about it. Now over the max time frame, this is since around January of 2024, more or less, all these ETFs have performed pretty well. The number one performer being the SPY at 25.7% return. Right behind that is QQQI at 25.55% total return. And then behind that is SPYI with around 20.5% total return. Now again, as a dividend investor, I'd be more than happy at seeing around 8%, 12% total return every single year. Take that income, take that growth, compound it into my portfolio, and build a massive snowball later on. So now that I share with you guys some of my ideas behind dividend investors buying into something like SPYI and or QQQI instead of buying into the typical dividend aristocrat names like you can see right here as we scroll through, and basically share with you guys that at least historically speaking so far, I know we don't have a ton of time to go off of, but some of these cover call style ETFs that track underlying indexes like the S&P 500 and or the NASDAQ are basically keeping up with the SPY, and if not all that far behind, which is definitely impressive and in my opinion worth at least looking into. Now again, if you're not necessarily focused on income potential, if you want much more growth potential, buying directly into the S&P 500 and or the NASDAQ is probably going to outperform the cover call methods because again, the cover call ETFs have capped upside, etc. But if you're a dividend investor like myself that wants income potential, wants it to be somewhat at least tax efficient, and wants some potential for capital appreciation, well, cover call style ETFs like the ones we talked about in today's video are definitely at least worth looking into, if nothing else. But now lastly, before I go, I do have one question for you guys to comment down below. Out of all the cover call style ETFs in the market right now, and I know there's tons of them, which is your number one favorite and why? Let me know down below in the comments. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.